Welcome to the Retirement Roadmap by SHP Financial, a podcast empowering today's retirees and pre-retirees to make well-informed financial decisions that will help you spend more time living and dreaming than worrying and wondering. Join me, Matthew Peck, along with my co-hosts, Derek Gregoire and Keith Ellis, as we share actionable financial strategies and insights, as well as interview top thought leaders in the world of finance, accounting, and estate planning. This is all aimed at preparing you for the retirement you've always dreamed of. Our high-quality holistic planning process has helped thousands of families retire and create what we like to call the ripple effect. The Retirement Roadmap is your guide to financial freedom. Are you ready to get started? Let's go. Welcome, everyone, to another edition of SHP Financial's Retirement Roadmap podcast. I'm your host today, Matthew Peck. Today, we'll be talking about gold. Gold as an investment. Gold as a diversifier. What role does it have in portfolios? And why has it surged so much in 2025? To look into some of these answers, we hauled in one of our top analysts at SHP Financial and soon-to-be father of a second baby in a couple months, David Hathaway. He's obviously a returning guest and very helpful in portfolios itself, and hopefully we'll be able to answer some questions for all of our listeners as to why gold and the role it plays. So without much further ado, Dave, welcome back to the podcast.
Yeah, thank you very much for having me.
Yeah, and I was going to say, so with I know we have a baby coming, and it's a baby boy, baby girl?
Right. Boy number 2. Yep.
Oh, man.
Coming in December. Very excited.
Right. Well, certainly on behalf of everyone here, we're certainly excited about that. I mean, that's we need more Hathaways in this world.
I think so.
Well, I love it. All right, my man. So let's talk a little bit about gold. I mean, when people ask you about gold, how do you generally respond? Like, what's the first thing that you like to tell people about gold as an investment?
Yeah, I'd say first off, it's been a store of value historically. Going back to ancient times, gold coins. That was the first sort of money that people transacted with. Mm-hmm. And it's remained a store of value even today. And, the way in which we invest in gold and transact in gold has obviously changed and modernized through the years, but it still remains very important. We see in modern times, central banks all around the world are buying gold as fast as they can. China especially, Poland, India are just a few of the countries that have been really aggressive with buying gold, and they're doing it so it'll be a store of value for them.
Okay, so to really start off, number one, when we talk in terms of gold, I mean, it's store of value, meaning that people will then sort of seek it out, not just for pretty things like bracelets and earrings and whatnot and rings and whatnot, but truly to make, truly make sure that investment, like what they buy, is going to be there tomorrow.
Yeah.
Right. And I think it's good for people to understand what store of value means, because think of it this way. It's like, if you buy a stock in a company and you pay, $50 for that stock, and that company goes bankrupt, that $50 is gone.
Exactly. Yeah.
Right. So you can't say a company is a store of value, because there's a good chance, depending on the company, of course, that the $50 that you invest in a share is gone. Or even if you buy their bonds, right, which is basically like a lending, like a debt, debt instrument. Same idea. If they go bankrupt, that money's gone. So you can't really say those types of investments are true stores of value. Whereas gold, at least that's the anticipation, right?
Yeah.
That's the expectation that, okay, if I buy $50 worth of gold bars or whatever that may be, that 50 should always be there for me in some way, shape, or form, because gold has been sort of treated that way for millennium.
Yeah, exactly. It's got industrial use cases. You can find gold in circuit boards. Obviously, it's in jewelry. So there's always going to be some sort of demand for the metal, outside of it just being a monetary store value. It also has other applications as well, and so I think that keeps the price, up, and at some level, it's never going to go to zero. Let's say.
Okay.
So you mentioned too, or we always love talking about how not everyone is a fan of gold, right? I mean, Warren Buffett is he's probably the most famous, one of the best investors, if not the best investor of all time. Certainly one of the more famous ones. He never liked gold. So why didn't Buffett like gold, and then why do people? Why do some dislike it and then sort of argue on both sides?
Yeah. And I was kind of in that camp for a long time too. Basically, it's because gold doesn't produce anything. It doesn't do anything. It's not a company that's producing widgets and giving investors dividends and rebuying shares. So it's not really involved in sort of the wealth generation machine. But despite all that, gold has continued to do very well. I think we were looking at a stat earlier. Since the 70s, it's up about 8% per year since 1971. So despite some of the challenges of not really producing any cash flow, the way things have worked out, gold's done very well. I was looking at another stat earlier. Since the inception of the very first gold ETF, exchange traded fund, the ticker on that is GLD, that launched in 2004. Gold has actually outperformed the S&P over that same time frame, which goes against conventional wisdom.
Well, and I think because that's one thing I love to point out is the fact that, okay, so it said 2004 to today, right? So where gold has technically outperformed the S&P 500, which is you couldn't even wrap when you sent that stat to me, it's like no way that gold would be better than the Nasdaq and the S&P and I'm not sure about the Nasdaq, but specifically the S&P 500. But in that 04 to today lies the answer to why it would do that, which is number one, you have 08 and 09, 2008, 2009, and then you had COVID in 2020, right? So I love studying gold mainly because it really becomes a historical study. Like it shines in these years, well, no pun intended, but actually I'll go with it. But it shines in these years of heavy volatility, of heavy uncertainty, of monetary issues and fiscal issues that we're seeing. So you're starting to get a feel for it because in 1979, during the energy crisis and the inflation spike, so this was outside of the years that we were originally quoting. In 1979, during the inflation and energy crisis, it's up 126%. 2020 was up 27% in 2020. So you get the idea that during those crises is when gold really stands out. And so tell us about 2025. So why is 2025 on that list now of some of the best performing years for gold?
Yeah, I think there has been a number of factors are going on. Geopolitical uncertainty, it seems like the administration is implementing all these changes really fast, and I think that has given investors around the world some concern and sort of a flight towards safety. You have our national debt has increased about $2 trillion just this year alone. You have some inflation concerns. Just yesterday, Trump was talking about $2,000 stimulus checks being sent out to individuals. That's very inflationary. And so gold has also been viewed as an inflation hedge. And so that would only spur the price of gold further higher. There was something else. I lost it.
That's okay. I mean, I can bring it back to to talk about each one of those things, right? So the first, let's talk about central banks, right? For years, and still to this day, the dollar is the dominant currency that the world sort of trades on. Oil is traded in dollars, and a majority of major global transactions, dollars are exchanging hands. And so now let's say you are a central bank, and we're seeing a new sort of more of a swashbuckling America first type of president comes in. And you know that, okay, if I'm trading in dollars the entire time, and now I run afoul of the new administration, I may get kicked out of the dollar exchange. Suddenly, Dave, like, sorry, you're not allowed to trade in dollars anymore because I'm America, and nope, you're out. You're not, you're a terrorist organization, whatever that may be. So suddenly you're like, wow, if I'm relying on dollars for my, sort of country's economy to move, that's not really a stable foundation to build my economy on. So what I'm going to do as a global bank, or a national bank, is I'm going to buy gold, because at least at that point in time, I have value. I have that store of value where now might be able to exchange dollars for gold or whatever that may be. So the impact of on the global banks and global instability, I think, is really, really key, because they're all buying in. The global banks are buying this gold because they want to make sure that all the different the instability and some of the tensions that happen, that they're not hurting the people that they're protecting. Yeah. If that makes sense.
Yeah, I think that's true. Also, there was back when Russia and Ukraine started, that conflict started, the U.S. Seized a bunch of Russian dollars. Right. And I think that has caused other central banks around the world to reconsider, not necessarily that they're going to go invading other countries, but at the same time, if that can be done to Russia, could it also be done to our country as well? Yeah. So I think that's another reason to diversify away from dollars into gold.
Right, and I think that's the biggest thing that I want to sort of convey with the conversation. We'll talk about some of the logistics and how you actually invest in gold, but it's more than just earrings and rings and and crowns and like because maybe that's just my own sense of living in my own historical geeky world. Like, I think of gold and I think of shiny things, and it's like, whoa, this is a major player in international finance and international politics. And so if you're going into, and I think it really shows up in 2025, if we're going into a world where there's the sort of not who knows whether it's a new order or whatever that may be, right? But you get the idea that there's a lot of questioning of how the post World War II rules were going to be, where we're sort of transitioning, and whether it's just a lurch and we go back. But we had the World Trade Organization, and we had all this rules-based trade that's sort of being torn up right now and sort of reconfigured. And that's the type of year that gold is gonna perform in, which is hence why it's up again 60%, as of this recording, which is still, I mean, in 1 year. As you mentioned about Buffett's, criticism, this isn't a company, right. This isn't a company making widgets, or this isn't a company that's sort of heavily part of the AI trade. This is a commodity. I mean, this is a sort of a metal, but it reflects what's happening in the world. Really, really well in that regard. Now, let's talk a little bit about inflation too, because it's also a major impact of inflation. So how does gold and inflation kind of interact?
So it's historically been a hedge against inflation. So when we talk about inflation, we're talking about dollars losing value, essentially. Mm-hmm. There's too much money in the system. Your dollar doesn't go as far as it used to. But gold is sort of outside of that system. So it has historically maintained its value regardless of what inflation's doing. And maybe that's just perception that this is what gold does. So let me go buy gold bars. But it's just been able to handle that. The other thing I was going to say earlier,
came back.
Yeah. Sorry.
Baby brain. Sorry, everyone.
As the Fed is cutting rates.
Yes.
And
Great
so
point.
that's kind of related, to the sort of inflation trade. As rates go down, generally the dollar decreases. And so that's, again, another bullish point for gold.
Yeah, no, key point, because actually, let me go back to the Fed cut, the Fed rates, and then I'm going to jump back to inflation. So a little hopscotch here. But in regards to the Fed rates, and I'll go back to Buffett, and same idea. Like I should also say, I was not a gold bug at all, coming into this year specifically. And I kind of was with Buffett. It's like, well, why am I holding this thing that doesn't pay me any interest and dividends, right? Well, suddenly if CDs and money markets and bonds are paying less interest, well, that's less. That's now less appealing of an asset.
Yeah.
And gold suddenly becomes more appealing because now, rather than if I'm getting 4% on a money market and gold giving me 0, well, if money market's paying me 2% and gold is providing all of this inflation protection and sort of safe harbor, well, again, gold becomes a lot more appealing, at that point when it's a 2% versus a 4% swing, on the interest rate. To come back inflation, I mean, you gave a term of, $2 trillion in debt. Part of, which is why it's like a perfect storm for gold this year.
Yeah,
right?
It really has been.
I mean, because think of it this way. We're adding trillions of dollars. Neither party is talking about austerity or raising taxes or controlling debt. It's sort of, in every one of our quarterly market updates, we talk about how concerned we are at the long-term fiscal outlook, and they'll say, okay, we'll grow our way out of this debt, and that'd be great. I really, really hope that they do for everyone's sake. But if they're unable to grow their way out of this debt, inflation is what governments have done historically to make it easier to pay off their debts. So for everyone, these global investors that are just saying, well, gosh, they're adding $2 trillion. Well, what happens if they can't grow their way out of it? Well, the only other way out of it is inflation. So let me again buy this gold, because they're going to weaken the dollar in order, and if the dollar is weak, then gold will continue to hold that value if the dollar isn't holding the value. Does it mean?
Yeah. There's no shortage of bullish points for gold for this year. Who knows? We did see some volatility a couple weeks ago. Price came down pretty substantially over a couple days, but then it's kind of crawled right back up above 4,000. Earlier this year, Goldman Sachs had a price target of 4,000. Now they're saying $4,900 an ounce. So that target just keeps inching higher and higher.
Well, I think the longer that everything is happening in the news is probably at least. I mean, obviously everything's cyclical, and I should also quickly state this isn't a recommendation for gold. Everyone's situation is unique. Talk to your advisor, things along those lines. Sorry, this message brought to you by the compliance department. But it's a fact. It's a fact. But okay, so with that being said, logistically, how do we invest in gold? I mean, are we like, do I have a pick and shovel? What am I doing? Am I panning? Am I
panning in your backyard for some gold? There's lots of ways.
I found a lot of soggy, nasty leaves. That's all I got. Are those valuable? Is that a store of value? God damn it.
So there's lots of different ways. Historically, folks have gone out. There are people or companies that will source gold for you, coins, bars, that sort of thing. Fidelity actually does have a physical gold department or physical metals department. The easiest way for most investors to access it is through ETFs,
which are what? Just to
exchange traded funds.
Okay.
Most of those are backed by real physical gold. Mm-hmm. You would have to do a little bit of research to determine if it does have a physical gold backing. Most of the times they do, but sometimes it's just they get there through options or something like that. So physical gold can be purchased, exchange traded funds, futures. ETFs, exchange traded funds, is really the easiest
Probably
way.
The most common way. Just because I know people they like the idea of gold bars. So if you don't mind, explain. So someone would like buy gold bars, or they'd go to Fidelity and buy some as an example, and then they would just give dollars, and now they have gold bars somewhere there. Is that kind of how it works?
Yeah. Yeah, it can be kind of costly to exchange if you ever wanted to get out. Generally, you have to take a haircut on the price. It's not, I would say, the most efficient way to own the metal. ETFs are by far the most efficient way to
Which is
to
interesting.
participate.
Well, it's funny. I was going to say, Dave, it's interesting because we normally explain exchange traded funds. Well, they're funds, which means they're diversified. And let's say the S&P 500 is an exchange traded, or can be an exchange traded fund, and that's 500 companies, but all packaged into one fund and one ticker that you can trade. So gold, even though it's not really diversified, it's just gold within that fund. But an exchange traded fund is the easiest, most convenient way to get involved.
Yeah, I think so, definitely.
Okay. And then generally speaking, what do, I mean, I guess might be different from an analyst than a financial advisor. And so what are ranges of allocations that you'll hear in the industry when it comes to, okay, here's how much you should have in gold, or if you're considering gold, here's a range to consider?
Yeah, I think you'd probably want it as part of sort of a safety bucket. Again, it's traditionally viewed as a store of value. So maybe it's where you would have some of your bond allocation, you could allocate to gold. 5 to 10% is the typical range. I probably wouldn't go much higher. I probably wouldn't go higher than 10%. Okay. This year has been great. Last year was great for gold. But going forward, we just don't know, what it'll look like going forward. But I think it makes sense given what we've seen, the last couple of years. I think it does make sense to have a small allocation towards gold.
And then and actually, let me pick up on one point. Then I'll go back to sort of portfolio construction and kind of how SHP approaches it. The idea of these like surges. I feel like gold's flat for a decade and then surges up. Then it's like flat for a while, then surges up.
Yeah.
So it's not this. I mean, I guess most investments aren't this straight line forward, of course, but I feel gold sometimes can be dormant and sort of goes to sleep for a bit. You don't really see much action, and then next thing you know, it pops because the perfect storm sort of arises, whether it's inflationary concerns, global bank buying, debt crisis, things along those lines. So yeah, I manage your expectations really is my main point to all the listeners, because it really is. Any investment is a long term, or should be viewed. Obviously, in our opinion, should be viewed as a long term perspective. Now, in regards to portfolio construction, you talk about 5 to 10% allocation. How? I know we have an alternative sort of portfolio. I mean, would you consider gold alternative? I mean, do you consider it? I mean, I guess what's the correlation? Correlation means how much it moves for all the listeners. Correlation means how much gold will move with the S&P 500. So if one zigs, is the other zag, or do they move together? So where in your definition, where does gold fall into the overall? Is it an alternative? Is it core position?
Yeah, it's traditionally viewed as an alternative investment with other hard assets like real estate, managed futures, that kind of thing. But it's definitely an alternative investment. Mm-hmm. It's not traditional.
Okay. Because on that end too, it's funny, we've been having different podcasts on alternative investments, and whether it's private equity, private credit. I think it's kind of all building, or I think portfolios just evolve through time, right? So when we talk in terms of hard assets to real estate, as you mentioned and as you suggested, I think it kind of all falls under that category where if a client says, okay, hey, I want 10% in alts or alternatives, how should I break up that 10%? And then we start to really bring in, the gold conversation. One thing I did want to ask you about, because we talk about store of value, and this term is also in the news a whole lot. So as a teaser, I talk about correlation, right? I talk about, all right, if the S&P 500 zigs, does gold zag? The other comparison that we hear a lot is Bitcoin, where Bitcoin is digital gold. Bitcoin is, the next store of value and things along those lines. So how does Bitcoin and gold interact? And do you see it kind of in the exact same world, or do you think that's a completely different topic and a completely different type of investment?
Yeah, it definitely is similar aspects of it. but they're definitely different. Historically, Bitcoin has sort of tracked the NASDAQ and other tech stocks pretty well. Really strong correlation between those two. Gold, not so much. Not correlated to the S&P, not correlated to the NASDAQ 100. So it's definitely giving you the diversification that you want out of your alternatives bucket. Bitcoin hasn't done that yet. It might someday detach from the NASDAQ, but we've not seen that happen in the last couple of years. 2022 was a great example of that. Tech stocks took a substantial dip, and Bitcoin and other crypto went right along with it. Like I said, maybe that changes down the road at some point in the future, but as of today, it hasn't proved to be a diversifier.
Yeah. It's interesting you mentioned 2022, and that's why it took me a while to come around on gold, because I believe 2022 wasn't that good of a year for it. And I was thinking, wait a second, if we have inflation, why wouldn't gold do well in that aspect? But I think a lot of it also has to do with growth, and obviously our debt was a little bit lower at that point in time. But really coming into 2025, it's been remarkable. Of a rise.
We were also raising rates in 2022.
Right, yeah, exactly.
So that's not really the best environment for gold to perform. Cutting a easy Fed policy is definitely better for gold.
Yeah, that's a great point. That's a great point. Yeah, so I mean, it just shows, ladies and gentlemen, all the different factors that go in, and I'm just, and I certainly glad everyone hopefully is listening to the podcast, and I share that with you because I think generally speaking, when clients will come in, when they ask about gold, it's because they saw like a TV commercial, some like infomercial on that's late at night, and it's like, oh gosh, some guy hawking gold, and sometimes it could be a little snake oily in a way. I mean, have you ever seen some of those?
Oh yeah, definitely. Okay. And generally what they want to do is convert your entire portfolio into gold.
Yeah.
And that's not something that we would ever recommend. We will want to keep a balanced approach to portfolio construction for our clients.
Right, because I mean, as much as we talk about the debt levels and global instability and things along those lines, and I'm saying personally speaking, this was years ago. First looking into gold, I was like, wow, that's a very bunker mentality, right? In the sense of, well, hey, the world's going to pot. I better put my money here, and almost like a very pessimistic investment. Do you see what I mean?
Yeah.
And I think in literally can be put in almost like a scary type of investment. Like if you don't do this, then all your money is going to go gone. And I think in terms of those commercials, and it's like, whoa, okay, all right, we have to separate some of the fear. Or when you invest in gold, you have to have this type of information behind you as to why.
Right.
Do you see what I mean?
Yeah. We're definitely taking a informed approach. The conditions in the world are ripe for gold right now. That might not be the case in 2 years, and I wouldn't want to have most of my portfolio invested in gold for the rest of my life. I think we're looking at conditions as they are today, and we're making bets on the price of gold today and maybe out a couple years, but it's not something that we're tied to.
Yeah, which is a great point, because you think about the portfolio construction. I mean, like when the team first think about adding it to when they actually do add it. I mean, what's a 3-month process? I mean, I guess if you don't mind, explain a little bit about how the sausage is made in Inside Baseball on portfolio construction and the sort of introduction of an asset like gold into SHP's portfolios.
Yeah, I mean, I think it starts small, obviously. We started with a fairly small position earlier, at the beginning of the year in our alternatives portfolio. And since we've increased that exposure in that portfolio, but we've also branched it out towards a couple other portfolios as well. So I think it's a slow process of testing the theory, kind of confirming what we believe, and then implementation into the portfolios.
Well, and I think we'll kind of end on that in a sense, Dave, because it's like, I want people, all the listeners, to know whether it is at SHP or whether they're doing their own investing, or whether they have a team on their behalf. And if you don't have a team, obviously reach out to SHP, of course. But you get the point where it should be a slow, deliberate, and well thought out investment strategy, right? And of course, it has to match your financial goals. It has to match what your income plan is and your tax plan and different things along those lines. Because tax-wise, actually, I'll digress for a little bit. I mean, it's pretty much gold is going to be taxed like investment-wise, like any other investment, pretty much. Especially obviously if it's in your IRA. But to get back to my point, guys, like we were talking about making sure that that you don't sort of follow crazes, and certainly never sort of feared or you invest out of fear. We always want to make sure there's no scare tactics going in. But when you look at the backdrop, like you were saying, Dave, I mean, this is the type of backdrop that is the reason why gold is propelled as far as it has been. And so, as you're saying, whether it's 2 years from now, we don't know if those same conditions will be in place. So you're constantly reassessing the portfolios. You're constantly making sure that where we are positioned, we have what are called tailwinds, right? That the portfolio is set to grow because those are the types of conditions that we're looking for in whether it's gold or whether it's real estate or whether it's growth or whether it's value. And those are just the portfolio. That's why it's constant, where it takes constant work.
Yeah.
Right?
Yeah.
Does it ever get old for you? Like,
No.
when did you first want to get into portfolios and all of that stuff?
I mean, I had an econ class in high school and fell in love with this stuff almost instantly. And it's been, something that I've pursued relentlessly ever since.
Yeah.
So I really enjoy it.
And it never gets old.
No, never gets old. There's always something new out there. There's always price dislocations in assets, and discovering those. It's a lot of fun.
Yeah, no, absolutely. And obviously, we're very happy to have Dave here. To that type of relentless approach, we want that here at SHP. So, thank you all for listening. Certainly, if you have any questions, reach out to your advisor, or if you don't have an advisor, please reach out to SHP Financial. Hope you found it interesting, and be well.
Thank you.
Thanks for listening to the Retirement Roadmap podcast by SHP Financial. If you've enjoyed today's episode, be sure to hit the subscribe button so future episodes are automatically downloaded directly to your device. And if you've liked what you heard, please share the show. Create your own little ripples so we can help even more people with their retirement goals. If you want access to all past interviews, including notes, resources, and exclusive content from SHP Financial, visit shpfinancial.com/podcast. Thanks again for joining us on the Retirement Roadmap podcast. And for all the attorneys out there, and disclaimers and disclosures, I'm just going to put on my super serious voice and add our own. No statements made during the Retirement Roadmap podcast shall constitute tax, legal, or accounting advice. You should consult your own legal or tax professional on any such matters. Information presented is for educational purposes only and does not intend to make an offer or solicitation for the sale or purchase of any specific securities, investments, or investment strategies. Investments involve risk, and unless otherwise stated, are not guaranteed. Our investment advisory services are offered through SHP Wealth Management, LLC, an SEC-registered investment advisor. Insurance sales are offered through SHP Financial, LLC. Our advisors and insurance reps may offer clients advice and/or products from each entity. No client is under any obligation to purchase any insurance product.